So we're getting futures pointing in the United States to a higher open, but it was a down week last week for equities. And U.S. markets, of course, they're still well ahead of the TSX, but the tech stocks have given up a lot of ground. Our guest says, look for a resurgence in the commodities trade, and that could well lead the TSX higher. We are joined by Stu Morrow. He's Executive Director and Canadian Investment Strategist at Morgan Stanley Wealth Management Canada. It's great to see you.
Thanks, Adrian. Thanks for having me.
Just to kick off, though, you want to stress that it's not a horse race. You should consider your long-term goals, not be worrying about month-to-month fluctuations.
Of course, from a tactical perspective, that's a 6 to 12-month outlook. But from a total portfolio perspective, long-term is the game, and that's all about diversification. That's about, using simple and boring strategies like dollar cost averaging, which don't get enough airtime, but really get investors through a market cycle and volatility.
So we did see a resurgence in tech stocks this year after they got battered last year. I'm thinking in particular the NASDAQ. But if we look at the NASDAQ month to date, it stands something like 7%.
For sure. So if we back up and look at what we would call the beginnings of the bear market rally, which started in mid-October of 22, up until, like you said, sort of the beginning of August, the technology space and the S&P 500 has really led the way. And it's led the way on the back of multiple expansion. And 90% of the returns so far this year in the U.S. market have been driven by the expansion, the PE, and that's actually off of a few factors like additional fiscal stimulus, monetary stimulus through the U.S. banking system in March of this year, and then more generally enthusiasm around artificial intelligence. And let's not mistake in the fact as well that inflation has come off the highs, and of course that contributes a bit to that as well. But as we look forward, we have some questions whether or not those specific drivers around what's driven the U.S. market year to date will continue for the rest of the year.
So you say multiple expansion has provided nearly all the gains. Is it not 100%? I presume earnings are under pressure. So has the actual E and the PE not been coming down?
It has. So earnings expectations have been coming down. If we look out to 2024, for the S&P 500, for instance, we have some doubts as to whether or not a number of 250, 255 is going to hit the mark. We look
for S&P earnings.
For the S&P earnings,
yeah,
yes.
Yeah, sorry.
So that would be something that we would have some caution on, and that's generally why, from a tactical perspective, at Morgan Stanley Wealth Management, we're underweight the U.S. market from a global context.
That's interesting. And do you reckon it's a bit of a head scratcher that the U.S. market has been so strong, given these relentless interest rate increases and bank failures in the U.S.?
For sure, and I think the markets are coming to a point now where we're considering what the go forward looks like. So whether or not we're in for a higher for longer interest rate environment, as the market's trying to grapple with at this point in time, that's the interesting conundrum. But certainly on the fundamental side, like I said, we have doubts about the S&P earnings for next year. Sentiment, actually, depending on what side of the market you're looking at, but from a U.S. perspective, investors are still pretty bullish. So, for us to get constructive again on something like the U.S. market, we'd like to see some capitulation, some sort of flushing out in the market. We're far from that right now.
We haven't seen enough damage, in
Not
other
yet.
words. Yep. You think commodities, despite the worries over China's economy, have decent prospects right now?
I think from a starting perspective, so we also look at valuation, we look at fundamentals, and we look at technicals. But from a valuation perspective, the piece that we penned last month on compelling opportunities in Canadian equities did highlight the fact that, there's obviously the largest component in the TSX is natural resources and energy. So we do think that there is an interesting starting point from a valuation perspective for those two sectors, the materials and the energy space in Canada, that we think longer-term investors who are looking to get into Canada might want to pay attention to.
You touched on this, just too much bullishness still among U.S. investors. You want to see more pessimism?
For sure. I think, as we think about what are the next signs for the next bull market, we know markets tend to go up more than they go down. So we're always on the lookout for, what data are we missing? How could we be wrong? But some of the signposts, Andrew, we look for in the next phase of the bull market would be certainly a pullback in the multiple for the S&P. The equity risk premium in the U.S. is quite low relative to where we would would consider investors to get a compensation for equity risk. And again, sentiment is quite bullish. And all of those things, and let's throw in inflation, let's say adios to inflation to get really excited about the next leg of the bull market are some of the signposts we're looking for.
It's been tough to own bonds lately, but do you reckon people should always have at least a portion in bonds?
Definitely, and you know, from a global perspective, we're tactically overweight, slightly overweight fixed income. So, you know, we believe we're towards the tail end of the rate hiking cycle, which doesn't mean we're automatically thinking about rate cuts, but you know, towards the end of the rate hiking cycle is typically historically a point in the market where investors get paid to take duration risk. So we know investors are quite happy at sitting in cash today, getting 4.5%, 5% in some cases. But thinking about, you know, the go forward and diversification, you know, certainly extending some duration on the fixed income side is something we're tactically recommending.
Oh, that's interesting because obviously the longer bonds are more volatile.
Correct. So, you know, when we think about that, tactically from a total portfolio perspective, what other measures could you include in a portfolio that would help to offset the potential risk of that? So we look at the things on the alternative side, hedge funds, specific solutions like market neutral strategies, relative value, low volatility, historically have offered really great as good complements to a fixed income portfolio. So if we're thinking higher for longer, Andrew, and we're thinking about more fixed income weight, you know, potentially some a hedge fund exposure to help offset that and provide diversification.
One thing, though, I think some people have decided, well, why would I just not own high dividend stocks as opposed to bonds? Is there a risk in that strategy?
For sure. I mean, the equity side of the portfolio traditionally has more volatility. So, you know, although we do say in Canada you are getting paid twice the yield as you are in the S&P 500, which is attractive for Canadian investors on an after-tax basis alone, there is risk, right? And historically, the volatility on equities is higher than it is in fixed income. So if we look at it from a reward to risk ratio, bonds are certainly offering a lot more opportunity from that point of view. But dividends definitely in Canada are growing, and that's for a longer-term investor who's an income investor is still quite attractive.
Just finally, the banks reporting later this week. We get the first two kicking off on Thursday. Is there something investors should be looking out for, or what will you be focusing on?
Definitely the concerns around housing and you know how the banks are going to guide us forward in terms of you know, loan loss provisions. We understand that capital markets will be weak. Those results, you know, tend to come and go. But I think focused on, you know, how the banks are thinking about residential housing risk, commercial real estate. Those are some things that investors are paying attention to, and how they're managing interest rate risk as well. As we've had quite a number of quick changes in the bond market in the last few weeks. So how are banks thinking about that, and you know, what sort of guidance do we get on the margin side as well?